Right now, somewhere in this country, an ordinary person is sitting at their kitchen table staring at a letter from their bank with a knot in their stomach because their account was flagged, frozen, or reported. They believe they did nothing wrong. They simply moved their own money the way they always have. The reality is that in 2026, there are three specific types of transactions that can trigger a bank flag, a formal report, or even a temporary account restriction. Most people do not know what those three are, not because they are breaking laws, but because reporting rules and monitoring systems have evolved quietly, and banks are not required to explain how their detection systems work before they act. Today, we are going to walk through exactly what those three transactions are, why they trigger alerts, and most importantly, how you can continue handling your deposits, withdrawals, and transfers in a normal, transparent way without unintentionally raising red flags. Before we dive into the three transactions, you need to understand something important. Your bank is not simply a storage place for your money. Under federal law, banks must monitor certain activity and report specific transactions. This requirement has existed for decades under the Bank Secrecy Act and related anti-money laundering regulations. What has changed in recent years is the technology. Banks now use advanced automated systems that analyze patterns, not just single transactions. These systems flag activity that resembles patterns commonly associated with financial crimes. That does not mean you are suspected of wrongdoing. It means the software detected a pattern that fits a predefined risk profile. And here is what surprises many honest people. You do not need to be doing anything illegal to trigger a review. You only need to move money in a way that resembles a flagged pattern on paper. Now, let's look at the first transaction. The first is large cash transactions. If you deposit or withdraw $10,000 or more in cash in a single transaction, your bank is legally required to file a currency transaction report. This is automatic. It does not mean you are in trouble. It does not automatically trigger an audit. Millions of these reports are filed every year for completely legitimate reasons. If you sold a car for cash, received a cash inheritance, or operate a business that handles significant cash, depositing $10,000 or more at once simply generates a report. That report exists to create a record. In most cases, nothing further happens. The key point is this: the report itself is not a problem. Trying to avoid the report can be. That brings us to the second transaction: structuring. Structuring occurs when someone deliberately breaks up a large amount of cash into smaller deposits to avoid the $10,000 reporting threshold. For example, depositing $4,000 on Monday, $4,000 on Wednesday, and $4,000 on Friday instead of depositing $12,000 at once. Even if the source of the money is completely legitimate, intentionally dividing deposits to avoid reporting requirements is illegal under federal law. The intent to avoid the threshold is what creates the violation. Banks are specifically trained and required to look for patterns of repeated deposits just under $10,000. If that pattern appears, the bank may file a suspicious activity report. That report can lead to further review. The safest approach is simple. If you have a large amount of cash to deposit, deposit it in full. Allow the required report to be filed. Transparency is not a crime. Attempting to avoid transparency can create unnecessary legal risk. Now, let's discuss the third category, which has become increasingly relevant: digital payment platforms and peer-to-peer apps. Services such as PayPal, Venmo, Cash App, and similar platforms are now subject to expanded reporting requirements. In recent years, the threshold for reporting income through these platforms has been lowered significantly. If you receive payments through these platforms for goods or services, even small side work, that income may be reported to the IRS. Many people who casually sell items, freelance occasionally, or run small side projects are surprised to receive a tax reporting form at the end of the year. This does not mean you did anything wrong. It means the platform is complying with reporting rules. The important thing is record keeping. If you receive funds for business activity, even informally, keep basic records of what the payments were for. If you receive money from friends for shared expenses, keep a simple note of the purpose. Clear documentation eliminates stress if questions ever arise. There are also a few additional practical steps you can take. First, review your financial patterns. Avoid repeatedly depositing just under reporting thresholds. Second, maintain simple records for unusual transactions, large gifts, inheritances, or sales of valuable property. Third, if you operate a small business or side activity, track income and expenses consistently from the beginning. Fourth, if your bank contacts you about unusual activity, respond promptly and calmly. Provide accurate explanations. In most cases, reviews are resolved quickly when documentation is clear. Fifth, understand that different banks may have slightly different internal monitoring systems. If your financial pattern is unusual but legitimate, such as irregular income or frequent international transfers, it can be helpful to proactively discuss this with your bank. The goal is not to avoid reports. The goal is to ensure that your financial behavior is transparent and documented. Most people who experience account flags are not criminals. They are ordinary individuals who did not understand how automated systems interpret certain patterns. Understanding the system does not make you suspicious. It makes you informed. If you ever face a complex situation, consult a qualified tax professional or financial advisor. This information is provided for general educational purposes and is not personalized legal advice. When you understand what triggers reporting, you move from reacting in fear to acting with clarity. Large cash transactions generate routine reports. Structuring creates legal risk. Digital platform income is increasingly reported. With that knowledge, you can manage your finances confidently and avoid unnecessary stress.